Good afternoon, everyone. It's Nick Dexter here. It gives me great pleasure to be the chair of today's webinar. I would like to extend a warm welcome to you all and to thank you for joining this webinar today. This forms part of the MFSA's continuing efforts to engage with the industry in relation to the expectation of regulators. Today's session is aimed specifically at the board members of banks in Malta or those who advise them. The key aim of this session is to provide more information on the MFSA's expectations of board members in respect of the oversight of business and controls. This is of particular interest to me, being both a regulator in the UK, but importantly, I'm also a board member of a regulated company in Malta. Before giving you a quick preview of today's programme, I wish to highlight a few points. First of all, the MFSA takes security very seriously, and this webinar is being conducted using Microsoft Teams, which follows all the security best practices. For this live transmission, we are also taking all the necessary precautions and protocols established by the health authorities in view of COVID-19. Secondly, please note that this webinar is being recorded and will be uploaded onto the MFSA's website. Thirdly, certificates of attendance can only be generated if you have logged on into this webinar using your email details and full name. As you can appreciate, no certificates can be issued to individuals logging in anonymously. If you are not currently logged in with your credentials because you have not created a Microsoft account yet and wish to receive a certificate of attendance, you may access the document available on the events page of our website that has been prepared to help you create a Microsoft account in order to be able to log in with your personal details. Finally, can you submit any questions for the Q&A session to MFSA staff on their presentations in the Q&A section of this webinar, which can be found on the top right-hand top corner of the screen. This is a great opportunity to get feedback directly from the MFSA team, and it will certainly make my job easier if we've got lots of questions for me to ask the presenters. Now, on to this afternoon's programme. To start off with, we have MFSA speakers who will talk about different aspects of the board's role. At 1:20, we'll have a short coffee break, and then we will start the second session at 1:40 with a question and answer session, after which Anne Fruga from the ECB and I will give our own perspectives. Finally, we have a panel session at which David Ecott, Anne and I will be joined by Lara Casar from APS and Fruga from Mercanti, and we aim to finish the webinar by 4:30. I would now like to hand over to David Ecott, who many of you will know is Head of Banking Supervision at the MFSA. David.
Good afternoon. Welcome to the first MFSA conference for non-executive directors in banks. I hope this will become an annual event, and if we can meet in person, provide a good networking opportunity and forum for lively discussion. However, given that we have to hold this one online, we've extended the invite so that others may participate, and as a result, there are around 230 attendees today, which demonstrates the level of interest and importance of this type of engagement. I hope the transparency this delivers will be helpful and you all have an enjoyable online conference today. My first duty is to thank all of you for giving up your time to join us online, and for those who've given up their time to help us prepare and run this event. In particular, I'd like to thank Nick Dexter for agreeing to be the conference chair, as well as Anne Fruga from the ECB, Lara Casar and Fruga for their support. The perspectives each will bring will, I'm sure, enrich the event. I'd also like to thank the members of the MFSA Banking Supervision team who've also given their time to prepare and present today, and in particular, Nikos Grapsas, who's organised the event for us. The first thing I wanted to say was that I think the job of a non-executive director is not an easy one. There is a great deal to think about, from business performance and viability, risk management, stakeholder engagement, including an effective regulatory compliance and relationship, staffing and management issues. This all takes collective skill and experience and time. But it is increasingly about a good understanding of the complex regulatory environment in which banks operate. Today, we'd like to explore how a non-executive director can demonstrate to the regulator that they are using their collective skill and experience to exercise appropriate oversight. Oversight is a word in English which of course has two meanings: a mistake because of a failure to do something, and responsibility for a job or activity and making sure it is done properly. The purpose of today's conference is to provide an insight into how we evaluate non-executive directors are doing the latter to avoid the former. We do this because, in our experience as regulators, financial and operational failures normally result from a failure of proper governance and oversight. These failures can take various forms: a misplaced faith in past performance as justification for not adopting modern risk management techniques, too much reliance on senior executives or an assumption that they have provided a full and accurate picture without a proper understanding of the incentives which drive their behaviours, a poor understanding of new risks, and maybe most damagingly, a sense that poor governance is something that occurs in other banks but not in the one you run. All banks have a reasonably significant risk profile, whether that stems from the structure of their balance sheet, the AML or terrorist financing risks associated with their connectivity to the financial system and customer profiles, or posed from cybercrime, operational events, or economic shocks. Regulators must understand and evaluate how you are managing this broad risk profile because of the important role banks have in society. Banks are the trusted place where customers place their money to be safe, or on whom businesses rely. The role of the chair is pivotal in any board. I will be speaking to the chair of each bank the MFSA regulates every year. In these sessions, we will expect the chair to be able to display a good understanding of their bank's risk profile and how they have put their board team together to support them in oversight of the bank. The team should bring together a diversity of backgrounds and thought to deliver an effective framework for challenge and oversight. The non-executive directors should be qualified in their field, independent and free of conflicts of interest arising from previous connections to the bank or its owners to bring the right level of credibility to the board. We will also talk to the chairs about succession planning and diversity. Both are important in providing sustainable and a broad set of skills and experience, but also to drive the right culture in the board itself. One thing we have noticed in a recent survey we compiled for the ECB is that Malta's banks are generally overseen by men, and indeed men of a certain age. From this group, or selecting from this group, limits the pool of talent in an already small market. I think the industry collectively and board chairs individually will need to demonstrate that they are working to change this over the next 2 years. Boards should become more gender and age balanced to demonstrate their culture is evolving and they are bringing in people with a good understanding of the modern regulatory environment. Our regulatory assessment of governance will cover these dimensions. In addition to our discussions with chairs, we will interview a range of board members over the course of the next 2 years and will assess how different perspectives contribute to the challenge and oversight. My colleagues are going to run through some of the questions we're going to be asking you in those discussions. I hope their presentations provide a useful insight into how the MFSA will undertake its governance assessments. But as the regulator, we are not here just to test. The purpose of today is to show the MFSA is here to engage and provide a transparent explanation as to how we seek to achieve our objectives. We believe it is in our interest to cultivate a good relationship and dialogue with non-executive directors to support delivery of better regulatory outcomes, whether that is financial or operational resilience or treatment of customers. Where boards engage with the regulatory agenda and show they are trying to respond to our observations and can deliver good outcomes, we can support those efforts through further discussions around the type and timeframes of regulatory actions we take. I would also emphasise that this isn't a one-way dialogue where the MFSA exclusively picks the topics and timings of our discussions. If you have things on your mind that you would like to discuss with us, then you should feel free to ask for a meeting as well. We're happy to attend a slot at a board meeting or take time out to talk to non-executive directors individually to help ensure that there's a good understanding of the regulator's views or to discuss your views on current matters. I hope you will find today useful, and I look forward to meeting more of you as we progress our work. Your feedback on today or the work of the MFSA in this sector will always be welcome. Thank you very much for your attention. I'm now going to pass over for the presentations.
Thank you very much, Dave. So my name is Nikos Grapsas, and I'm a member of the Banking Supervision function in MFSA. Today's presentation will start with business plan and stress test. So business plan and stress test, in our understanding, are integral parts of strategic planning process, an area that has been already identified as a high priority supervisory area for 2021. And in our view, the strategic planning process comprises of three main blocks. One of them is the business plan that actually forms a roadmap for banks to achieve their business targets, and this is represented by the green area in our graph. The stress test, that is the tool that banks have available to assess the business viability under stressed economic conditions. And the recovery plan that identifies the available options that banks have in order to restore business viability under extreme shock. The strategic planning process, in our view, has some overarching principles. You can see them on the right-hand side of the slide. And we expect that the board members share these principles with us and promote abidance with these principles during the business cycle of the banks. Moving on to the business plan, some particular information that we would like to discuss with board members during the interaction with them is governance. And under governance, we would like to understand what have been the main areas that provoke debate during the approval process. We would like to understand whether all key stakeholders of the bank have participated and have contributed. The areas that might be challenging when banks will try to meet their targets, and perhaps whether the business plan has been subject to internal audit review. Moving to more quantitative information, we would like to discuss the balance sheet. The balance sheet and mainly the drivers that are assumed to take place when we have a balance sheet growth. We would like to discuss the funding mixture and how comfortable the board members are with the proposed funding mixture, and perhaps how flexible it is for the bank to change this funding mixture in case of a different scenario or macroeconomic environment. Another area that we would like to discuss is revenues, and again, we would like to see the main drivers of revenues. Under revenues, we will discuss the net interest income and other particular components of revenues according to the business model of the bank, like fee and commission income. Other parts that we would like to receive information is pricing. Under pricing, we understand that the pricing model of every bank should include some components like the cost of funding, the operating expenses, cost of capital, and expected credit loss, of course. A specific discussion will focus on cost and whether the assumptions for costs are reasonable, whether all costs have been considered during the development phase of the business plan, and particularly if we have expansion to new business lines and new products, that discussion about cost would be very much relevant. Finally, we come to profitability. And under profitability, we would like to understand why the particular level of profitability is considered to be appropriate for the bank according to the business model. And of course, whether profitability will contribute to internal capital generation. Having said that, I would like to close my presentation saying that a good business plan is a business plan that provides detailed analysis and granular information, and in order to allow board members to make informed decisions and support other processes of the credit institution. Thank you very much for your attention, and having said that, I will pass the floor to Elias, my colleague, who will discuss the stress test. Thank you very much.
Thank you, Nikos. I'm Ilias Georgakopoulos, and I'm part of the ongoing supervision team. The focus of my presentation is on stress testing, which, as my colleague mentioned, is a key element in strategic planning. Why? Because one of the main objectives of banks' stress test is to assess their viability in a market-wide stress scenario, for example, as well as provide a framework to the board to assess business planning. As supervisors, the first step we take to assess viability in stress testing is to ask questions. For example, how did you ensure the scenario was severe but plausible and appropriately applied to the balance sheet? Or how did you demonstrate understanding of how the balance sheet reacts in a stress scenario? The reason is that by asking such questions, we are able to assess one of the main building blocks of a good stress test. For example, we've seen some credit institutions that demonstrate a very good understanding of how assumptions made in a stress scenario contribute to the severity of the stress test, evidenced, for example, through the capital depletion and the bank's risk appetite, or credit institutions that have a good understanding and a good articulation of the factors that are driving the changes on the balance sheet. While for some other credit institutions, there is room for improvement on both aspects. Now, if viability is placed under significant pressure, what are the options available to the board? And this brings me to the second topic that I want to emphasize today, the recovery plan, which is important because it contains the recovery actions available to the board in order to mitigate the impact of the stress and therefore restore the financial position of a bank in order to meet the capital requirements. One of the questions we will be asking during our interviews with non-executive directors is, how did you evaluate whether the recovery actions are plausible and effective in a stress scenario? And to give you an example, if a recovery option would be to initiate a capital increase from issued and paid up capital, have you considered any previous experience in this option, any legal or regulatory requirements and operational aspects that may slow down its implementation? Or is the timing of the recovery actions invocation properly documented in the recovery plan in order for the board to know how much time will it take to actually implement such recovery actions? Lastly, on the effectiveness, one question would be whether the recovery options are good enough in the sense that they can restore the financial position of a bank in order to meet its capital and liquidity requirements. Moving on to the next slide, The last point I want to highlight is the P2G and management buffer, which is meant to be held over minimum capital requirements in order to ensure a bank meets such requirements through an economic cycle, as well as ensure the adequacy of its own funds. In this slide, you see some of the questions that we will be asking during our interviews, which actually are questions that we ask to ourselves when we review ICAPs and ILAPs. But I would like to focus your attention on the purpose of the P2G and management buffer. The regulatory P2G aims to address concerns about the sensitivity of a credit institution to the adverse scenarios used in the stress test, as well as assess the adequacy of own funds, of the institution's own funds in stress conditions. As MFSA, we would expect banks to demonstrate in their ICAPs how they determine a P2G. On the other hand, the purpose of the management buffer is, for example, to cushion uncertainties around projections of capital ratios in order to reflect the institution's risk appetite statement, and as always, allow some flexibility in its business decisions. To conclude, appropriate governance in stress testing is important, mainly for two reasons. The first one is that governance per se is always important in ensuring viability of a credit institution. The second reason is that through good governance, non-executive directors can contribute to a properly implemented stress testing framework. Thank you very much for your attention, and I would like to pass the floor to my colleague Ruth Grioli. Thank you.
Good afternoon, everyone. I'm Ruth Grioli and form part of the Banking Supervision's on-site team. Together with my colleague Nikos, we're going to base our presentation on the role of the non-executive director in keeping an oversight on the second and third line of defense. As part of our supervisory dialogue with the license holders, directors, both the ongoing supervision team as well as the on-site team carry out various interviews with members of the board, including NEDs. Some NEDs are also interviewed on their role as the chairperson of the audit committee or the risk committee. In this slide, we are listing down the areas that are discussed during such interviews. Directors are requested to explain how they have ensured that the quality and quantity of resources that are employed within the second and third line are adequate and have appropriate knowledge, skills, and experience. Here we expect NEDs to refer to the institution's business activities as portrayed in the business plan through benchmarking with other peers, while also referring to internal audit exercises and external reviews. We also expect that staff within the second and third line are afforded regular training, which should be targeted and relevant to their area of responsibility. NEDs may also be asked to explain how the reports forwarded from risk management, compliance, and internal audit functions are being utilized in order to be informed about the institution's risk profile. The authority expects directors to be well aware of the institution's risk profile and have a view on whether the information being received from the executive management is adequate and assist the directors in gaining sound knowledge on the risks within which the institution is ready to tolerate. A director should be comfortable in the way an institution is assuring that all the risks it is exposed to are adequately and independently identified, measured, limited, monitored, and reported. From the reporting of the second and third line, directors need to be fully aware of the internal controls in place and establish that the recommendations emanating from these reports are being implemented in order to have a more robust internal control environment. We also expect directors to be able to explain where improvements in reporting were made or need to be made to assist the board in getting a better overview of the second and third line. During our interviews, NEDs might also be asked to give examples to indicate the effectiveness of internal governance when it comes to the board's decision-making. Here we expect that directors refer to specific instances when they challenged board debates and played an active role while discussing the institution's risk strategy, tolerance limits, and during the approval process of the suite of documentation that are submitted annually to the authority, such as the ICAP and the ILAP reports. What makes for good quality board reporting? When we ask questions about reporting, we are expecting NEDs to be able to show us how they assess that management information which is being disseminated in the risk reports is adequate, sufficient, and of good quality, which should serve as a good tool for the directors to assist them in getting a better understanding of the institution's risk profile. The board needs to ensure that the institution's risk strategy, together with clear documented operational processes, are disseminated throughout the whole organization from top to bottom. NEDs need to keep an oversight by ensuring that risk limits within which the business targets may be achieved are developed, implemented, and constantly monitored in a structured and formal way. KRIs need to be relevant to the business strategy and tailor-made for the institution. They need to be in line with the institution's overall risk appetite. NEDs need to demonstrate how the board is keeping an oversight on the monitoring of the set risk limits within which the business targets can be achieved and ensure that risk-related actions, which are to be referred to in case of emergency, are developed. NED should indicate how the compliance reports that should be presented to the board on an ongoing basis is providing the board with assurance on the effectiveness of the compliance function in order to manage the entity's compliance risk. It is also expected that NEDs are conversant within the measures the institution is taking to ensure compliance with the applicable legislation and regulation. As stated in the MFSA strategic update for 2021, which was published last month, the authority is well aware that compliance is becoming an increasingly complex domain. We firmly believe that a compliance culture is not a burden nor a cost, but a must to enhance and improve profitability in a sustainable manner. When it comes to internal audit, NEDs need to prove that the internal audit is operating effectively by supporting the internal audit function in discharging its duties. The board should establish an audit committee with one of its remits being that of providing an overview and an oversight on the function of the internal audit. In the case of small institutions, when there is a joint audit and risk board committee, it is important that both areas be given adequate attention without one area impacting on the other. NED should ensure that the institution has a properly defined internal audit universe, which is not limited in scope. This should include internal audit exercises on the risk management and the compliance function as well. The board and audit committee should ascertain that there are no long outstanding items when it comes to the implementation of corrective measures following internal audit exercises. An indication that the internal audit function is operating effectively is when remedial action is taken as swiftly as possible and improvements in processes or risk management are being noted. Furthermore, the internal auditor should be able to attest to biannual bilaterals with the chair of the audit committee and provide an annual assessment of the overall risk profile of the institution. In concluding, good quality reporting serve as a tool for directors through which they would get an insight into the operations and culture of the institution. Reports which are tabled and discussed by the board, be it risk reports, compliance reports, internal audit reports, and outstanding actions reports, reports on training being offered to the institution staff, staff feedback data, and customer satisfaction data, all help directors in understanding the modus operandi of the institution. Directors are urged to think whether the present reporting to the board is of good quality or needs to be enhanced in order for them to make a good assessment on the institution's business operations and culture. I will now pass on the floor to Nikos to take you through the second part of the presentation. Thank you so much for your attention.
Thank you very much, Ruth. So when we come to assess the effectiveness of non-executive directors, we would like to draw your attention to some additional information relevant for our assessment. One of this information would be evidence on the challenge that board members performed to executive team during the business proposal and the approval process. We would like to see, for instance, examples where the board of directors have requested additional information to finally reach an informed decision and approve the business proposal. When we come to assess the regulatory documents like ICAP and ILAP, we understand that these documents might be very lengthy and very complex. So a good way to improve the quality of these documents, in our view, is to engage board members early in these processes. And a typical example would be the case where the macroeconomic scenario has been finalized and concluded by the executive team. This scenario can be delivered to board members for their review and their feedback. And this will allow afterwards the executive team to timely incorporate this feedback into the following parts of these processes. Another relevant area is the minutes of meetings that are provided to us by banks. Under these minutes, we would like to see that due attention has been given to regulatory matters. We would expect these meetings to have granular information and substantiate the decision-making process. We expect that the 3 lines of defense follow a self-assessment framework. As you all know, the EBA guidelines on internal governance prescribe that the adequacy and the effectiveness of the control functions fall under the ultimate responsibility of the board of directors. And to this end, we would like to highlight that the self-assessment framework allows the bank to identify weaknesses and deficiencies in the control functions and point the corrective measures that board need to implement in order to improve the control functions. Finally, promotion of training is one other area that we would like to discuss. Under training, we understand that control functions and non-executive directors should receive regular modules throughout the annual cycle. And if we would like to summarize the training modules under three main pillars, one of them would be the core banking modules that would include modules that are relevant for all banks, like anti-money laundering, financial crime compliance, and legal issues. Another pillar would be modules that are tailored to the specific business model of the banks, according to the services and the products they offer. And the final pillar would be modules that are relevant to supervisory priorities, and that would include areas that have been already identified by MFSA. For 2021, for instance, we know that strategic planning process and the assessment of ICAP is one of these areas, the SREP assessment, the internal governance, and ICT and cybersecurity risk. Thank you very much for your attention. That would be all from my side. And now we'll pass the floor to Caroline Porter. She will discuss the minimum engagement level of MFSA and the interviews with non-executive directors. Thank you.
Thank you, Nikos. I'm Caroline Porter, banking supervisor within the LSIs. And my presentation, I will be explaining what a minimum engagement level plan, or MEL, entails. Obviously, for non-executive directors. That is what they would expect during these meetings, and in turn, what is expected from them. So what is an MEL plan? In brief, it is the minimum level of supervisor engagement or interaction by the supervisor with all banks. And the MEL is composed of core activities that need to be performed on a regular basis. That could be the SREP, or as we are mentioning, the MEL meetings. So as can be seen from this slide, these MEL meetings could be held with various components of staff members, and this includes obviously the non-executive directors. The aim is to ensure that over the course of the supervisory year, there is a continuous discussion between the supervisors and the bank. So what to expect during these meetings and before, obviously. So the timing of these meetings is fairly flexible. Sometimes might have them over a short period of time, for example, over a week or two, and sometimes we might spread them over the course of the year. The meeting would usually last between an hour and a half. And we will be sending the agenda in advance of the meeting. What would we as supervisors expect? So the non-executive would therefore be expected to be prepared not only when it comes to the items mentioned in the agenda, as we mentioned, that will be shared in advance, but also any other additional items that the authority might wish to discuss. The non-executive, together with the team, are to prepare a presentation for the authority, which then would be delivered on the actual day of the presentation. It is important that the presentation is shared with the authority in advance of the meeting. What is the expected outcome of this meeting? So from a supervisor perspective, we are to assess the effectiveness of governance as well as the competence of the NED on these agenda items, while at the same time, the discussion and the information gathered will form the basis of our SREP analysis. In the next slide, we will look at what one would expect as part of the agenda items. When it comes to the MEL meeting with the chair of the board, these are the items that would be at the top of the agenda. and the chair would be expected to convey their understanding of these points. So firstly, the chair during this meeting should discuss with the authority the effectiveness of the board composition and how this is commensurate with the bank's business model and business risks. Obviously, if there has been some self-assessment of the board and gap analysis, this will prove for an interesting discussion with the authority. Secondly, be able to articulate to the authority the board members' performance, both individually and also together as a board. Have an understanding of the ICAP and ILAP documentation together with the risk appetite framework, as well as the discussions and challenges which took place at board level when these documentations were discussed. Fourthly, understanding of the bank, how the bank is performing and its outlook. What are the main risks at the horizons that might impact this performance? And lastly, but as equally importantly, the inherent ML/FT risks faced by the bank and what the bank is doing to mitigate and control these risks. I hope you find this information useful, and I will now leave the floor to my colleague Anton, who will continue with this presentation.
Thanks, Caroline. Good afternoon, everybody. I'm Anton Markets. I'm a deputy head within the banking supervision unit. And today we'll cover the top agenda items that we would normally be discussing with the chairs of risk and audit committees. And later I will also present the main observations that stemming from our thematic review on governance that we conducted last, so in Q4 2020. So in terms of chairs of risk committee, we would discuss the risk appetite framework. So in this sense, risk strategy and how it linked to business plan. So we will discuss some main projections, limits, and KPIs, just to ensure that risk appetite statement is linked to the strategy of the institution. We would also discuss the oversight of the ICAPs and ILAPs by the board, so liquidity and capital management, just to ensure that those two are also linked to the strategy of the bank, to the risk profile of the bank, and how they are helping the board to efficiently monitor the implementation of the strategy of the bank. And in this sense, we would also be covering stress testing and scenarios provided in those stress tests, how they are linked to the business model, just to ensure that the bank during its operations is not breaching, for example, capital and liquidity requirements and overall stays within its risk capacity. We would also be discussing topical regulatory risks and broadly speaking development. So currently, for example, it would be a credit risk on the back of the COVID-19 pandemic, as well as risk related to climate change, just to ensure that those evolving risks are taken into account during the board's discussions. We would also be covering the adequacy of the second line of defense, so risk management function, so adequacy of the risk reporting to the board and to the risk committee, the adequacy of the resources provided to this function, and overall communication between the board and risk committee and risk management function. Very important, obviously, as was already highlighted by my colleagues, we would cover the controls around AML and CFT risks. In terms of audit committee chair, we will discuss the equality of financial accounting, integrity of the financial reporting. So we will discuss management and monitoring of costs, adequacy of provisions for credit risks. So in this sense, we would discuss the current overall financial position of the institution and its current performance against the business plan, so including profitability, costs, capitalization, and etc. We would also be discussing the adequacy of the internal audit function. So the scope of the audit plan, its implementation, whether it covers all the key risk areas, and overall whether it's linked to the business and risk strategy of the bank. We will discuss the main findings, the rectification of those findings, whether there have been any delays, and if so, what is the reason, for example, of those delays. And finally, we would also discuss the oversight of the external auditors and audit, the relationship with external auditors, the main findings stemming from the management letter and the implementation of those findings, and any issues with regards to external auditors, for example, resignation or change of auditors. So on this slide, so we would like to highlight a couple of areas where we think board should focus a little bit more on, and those are based on our observations stemming from the governance thematic review conducted last year, as I mentioned already. I'm not going to go through all the points listed on this slide. I believe that you will receive this presentation later, but broadly speaking, some institutions performed better than others during this thematic review, but in general, not all areas work as well as they should, in our opinion. And just to highlight a couple of areas, I think more important ones is that we would like to encourage that boards ensure more debate at board level around business strategy and the risk profile of the bank, not only current risk profile of the bank, but also evolving risk profile of the bank, so that it's taking into account the current strategy as well as the evolving strategy of the institution, to ensure that non-executive directors have a good understanding of strategy and the relevant risks. Also, in this sense, also connected, we would like to encourage to consider that there should be induction program for the non-executive directors, as well as the ongoing development plan, just to ensure that non-executive directors stay in line with the evolving regulatory environment, as well as evolving risk environment. Another area which we would like to highlight is that to ensure that the number of the board members is commensurate with the risk profile of the institution, and that it's sufficient to cover the main risks that the institution is exposed to. I think I will stop here. Thank you very much for your attention. I hope you found it useful.
Thank you, Anton, for your insight. I'm Kerspeter Lucas from the Financial Crime Compliance function of the MFSA, and together with my colleague Eric, we will delve into what is expected by NEDs in terms of anti-money laundering and financial crime. The presentation basically will focus on three main areas, but prior to that, basically, NEDs play a key role in the oversight of the bank's operations. Basically, the key role consists in overseeing that the bank's procedures are being implemented sufficiently to ensure that there's no breach of any regulatory obligation, as well as that the bank is ultimately not used to facilitate any form of financial crime. As I mentioned earlier, this part of this webinar will focus on three main areas about which an NED needs to possess sufficient knowledge and keep abreast with developments. Basically, these areas are the respective MLROs and the overall AML function, exposure to financial crime risks, as well as the bank sanctions procedures. Actually, in total, we aim to emphasize the importance that every board member, not only executive directors, but also non-executive directors, require to have knowledge of financial crime-related matters in order to improve the industry's overall financial compliance, financial crime compliance culture. So, basically, the first area is the adequate oversight of the MLRO and AML compliance function. We all acknowledge the importance of an effective financial crime functions. In relation to this, the supervisory authorities stress the importance of having adequate financial crime compliance functions supported and effective. Most notably, the MLRO role. However, we also acknowledge that the MLRO pool here in Malta is limited in resources, and financial services companies are experiencing difficulties to find MLROs. Most often, reasons include that the individuals might not be willing to take on the added responsibility that the MLRO role brings with itself, as well as an overall lack of experience and qualifications that would render the candidates not suitable for the role. In view of these points, NEDs are to ask themselves about MLRO comfort. The question basically to be asked is, how will I satisfy myself that the bank's MLRO, that my bank's MLRO function has sufficient seniority and is operating effectively? In fact, MLRO functions, some essentials of the MLRO functions are that the MLRO is given sufficient seniority, that it has adequate reporting lines, meaning having direct access to the board on a periodic basis. It's important, and that the MLRO or AML compliance function is provided with ample resources in order to enable the same function to exercise sufficient oversight and scrutiny on the policies and procedures that a particular bank implements. The NEDs must ensure that these points are in place at the respective bank. The NEDs might also do recommendations to the bank's management. For example, that possible extra staff is enrolled, including the possible enrollment of a designate MLRO to help the MLRO with its day-to-day operations, and even supporting specialized AML compliance staff. How can an NED actually see that these recommendations are being taken on board? Actually, from the MLRO reports that are submitted to the board on a periodic basis, the NEDs can see whether their recommendations are being taken on board actually by the bank's management. We all know that an MLRO is an integral part of the 3 lines of defense model being applied by a bank. And these assurance of the MLRO being adequate will only serve as further strengthening the bank's defense framework. Besides that, NEDs might also ensure that adequate training is being given at any point in time during the year to the bank's employees. It's not only just employees of the MLRO or AML compliance function, but also to all employees in general which work in departments which might come in contact with any suspicious activity. So therefore, training on topics such as not only the internal reporting system and customer due diligence, but also training on the risk assessment, the risk-based approach of the bank, the record-keeping procedures, and also money laundering, other money typologies of money laundering and financial terrorism risks. How are NEDs remaining aware of how banks are not exposed to financial crime risks? First and foremost, NEDs must ensure the adequacy of all the tools in place. When we say tools, it's not just IT-based systems, but all tools, including CRAs, IT systems, transaction monitoring systems, and also the procedures in place. And these are to inquire, for example, on the business risk assessment, which is a document which is very fundamental to a bank's risk-based approach. Some questions that NEDs need to ask in relation to the business risk assessment are whether the document is being updated annually. Whether is it taking into consideration the national risk assessment and the supranational risk assessment, whether the MLRO is included in its formulation and maintenance, and also whether the document is being scrutinized enough by the bank's different committees, such as the risk committee, the audit committee, and the board itself. One must also note that the BRA is a live document, so NEDs must ensure that the business risk assessment is being updated continually, and also that the document is taking into consideration the vast variety of risks, even if remotely, if a particular risk is very remotely to happen within a bank, but the NEDs must ensure that all these risks, remotely or not, must be included in the business risk assessment. NEDs must also inquire and ensure the relevance of the customer risk assessment methodology. NEDs should observe the bank's policy framework to cater for challenges in the institution services alongside the relevant updates being made to the CRA from time to time in order to enable the bank to establish a clear picture of the risks posed by the bank's customer base. Finally, the NEDs must also ensure that it's not just about anti-money laundering, but all types of financial crime. And they must ensure that the banks has policies and procedures in place to cover other types of financial crime, like anti-bribery and corruption, sanctions, tax evasion, etc. Now I will pass the floor to my colleague Eric, who will continue to focus on financial crime risks and also sanctions procedures. Thanks.
Thank you, Kurt, for your explanation. Before continuing on to finish off our part of this webinar in the next couple of slides, I want to invite you to post your questions in the Q&A section of this webinar. Moreover, irrespective of how clear and all-encapsulating banks' policies and procedures might be, mistakes do sometimes unfortunately occur, and these often come to light through the conduct of an internal or an external audit. Backlogs and gaps showing a bank's policies and procedures not being properly adhered to and conducted often put financial institutions in the direction of unnecessary risks. Therefore, you as NEDs should query and follow up on any highlighted issues that might come to light through the conduct of such audits by questioning how these are being remediated and addressed. Perhaps what you can even ask is with regards to what your respective board and relative department is doing to specifically address these situations and how your bank's procedures are being updated to reflect this. This can even extend to questioning on how independent reviews, as often stipulated in your bank's procedures, are being exercised. In addition to these, robust IT systems are critical parts of AML compliance. However, dated and siloed processes are often observed as being ongoing struggles. NEDs should observe that the IT systems that your respective banks utilize enable it to see the full picture with respect to monitoring customer transactions. And this might potentially be linked to across branches, businesses, and potentially even jurisdictions, all in an effort to facilitate the identification of suspicious customer behavior and transactions, as well as potential sanctions violations. To this end, NEDs should also ask for feedback on areas such as whether your customer data in a holistic manner is available in digital format, and whether the systems employed by your banks are able to handle the increased demands of compliance, perhaps due to their inherent limitations, and also challenge whether they need further updating or a replacement in their entirety. You can also query whether your bank's departments make use of systems that lack a common interface to exchange information and how this is affecting compliance and productivity in the long run. You can also challenge on whether your bank's central customer data repository has the level of sophistication and flexibility that would enable your bank to construct dynamic AML customer profiles. Now, another imperative aspect of financial crime are international sanctions. We acknowledge that the Sanctions Monitoring Board is the competent local authority with regards to the implementation of international sanctions. However, global financial sanctions are an integral tool in the fight against financial crime. And thus, you as non-executive directors and your respective banks must appreciate the increased focus that is being placed on the importance of sanction screening. The awareness and monitoring of a bank sanctions procedures is imperative to be exercised by NEDs. Therefore, you as NEDs should query and challenge these procedures by asking questions such as, what do your credit institutions sanctions procedures entail in the first place? What are the specific systems being used to cater for the global lists? And whether the systems, the sanction systems used are operated on a manual basis or work automatedly. And if automatedly, whether they are being relied upon blindly or whether independent tests are being exercised to ensure their validity. Another important point with regards to sanctions is the growing reach of US legislation. We can no longer argue that US legislation does not apply to Maltese entities. Therefore, you as non-executive directors should query on whether your bank's procedures cater for OFAC lists in addition to the other lists of global designations. The entire point of this is to ensure that the sanctions procedures put in place by your banks are adequate enough to ensure that it does not inadvertently put itself in a position where it breaches a sanctions designation, putting you in the direction of incurring a major financial penalty in addition to reputational loss. In conclusion, I would like to reiterate that the entire scope of our part of this webinar was to explain the importance of board members in monitoring key AML CFT control functions. After all, a heightened level of scrutiny on financial crime matters will translate into an improved compliance culture, both at board level and throughout your financial institution as a whole. Thank you for your attention, and I re-emphasize and invite you to pose any queries that you might have in the Q&A section of this webinar. Thank you.
Well, thank you, Kurt and Eric, for your contribution. Well, I must say this is the first conference I think I've chaired where I'm not chasing people to cut back on their presentation time, and that we've actually run ahead of schedule. So we're now going to take a break until 1:30 rather than 1:40, if we can all be back. We are going to do our best to address any questions you may have in relation to the presentations that have just been delivered. The Q&A session, which is scheduled straight after we get back, so we'll aim to cover things then. And again, if you have any questions and you would like to address either the panelists now or at the Fireside chat, which I'll be chairing later on, can you post the questions in the same Q&A session? Thank you, and I look forward to seeing you back at 1:30. Welcome back to the second part of our webinar. This is the dedicated Q&A session, and then we'll move on to our international speakers. We'll do our best to answer all the questions we've received. However, those which will not be answered due to time constraints will be collected and included in a FAQ document, which will be circulated among the participants in the coming days. So without further ado, I'll hand over to colleagues from the MFSA to answer the questions. Thank you.
Okay, well, thank you very much for all the questions that you've submitted. We've got a range of them across each of the topics we've presented, so we're going to field those. I've grouped them together so that we can cover the topics that seem to have generated the most interest. What I've suggested is we're going to go in reverse order. So we'll kick off with the questions on AML related issues. The first of these is for Eric. So the question, Eric, is why did you state that the OFAC sanctions are binding on Maltese banks?
Thank you, David. Basically, OFAC sanctions may be binding for local entities as a result of the wide scope of the US legislation itself. This may potentially leave Maltese entities as applicable subject persons under US law. In summary, Maltese banks can fall subject to US legislation, specifically OFAC sanctions, as a result of having a linked US correspondent relationship and being exposed to the US financial system, for example, even trading in US dollar.
Okay, thank you, Eric. That's very helpful. The second question in this area was for Kurt, and that relates to the business risk assessment. So the question, Kurt, was in the context of a dynamic business risk assessment, how frequently should a non-executive director be engaged with that document and made aware of updates to it?
Thanks, David, for the question. Basically, business risk assessment is required to be updated at least on an annual basis. And the document itself must also be approved by the board of directors. So technically speaking, a non-executive director's engagement in terms of the business risk assessment must be at least annually. However, this does not preclude any financial institution from updating the business risk assessment even on a trigger event basis, on an ad hoc basis. So actually, any update, a non-executive director must be in engagement with any update, basically, because the document needs to be also approved by the board of directors.
Thank you, Kurt. That was very clear. Okay, let's move on to the question that related to the frequency of the interviews with non-executive directors. So Caroline will answer this one for us. The question, Caroline, is how frequently would the MFSA expect to see non-executive directors, and what content would you be expecting in those discussions?
Thanks, David. So the frequency would be at least once a year. And with regards to content, obviously, it would be the items mentioned during our presentations.
Okay, thank you very much, Caroline. Okay. There was a question in on the oversight of risk functions, so I'll ask that one to Ruth. The question, Ruth, is what is it that we're looking for in when we're assessing a risk function?
Thank you, David. When we assess the risk management function as part of an on-site inspection, we do a thorough assessment of the risk management documentation that is being tabled and discussed during the board and the risk committee meetings. We check the quality and detail of reporting to assess whether these reports support an appropriate understanding and decision-making. We also would then test the understanding of the risk profile through our one-to-one interviews with the risk committee chair and other NEDs, as was discussed during our previous presentation. The two main ways a board can demonstrate that it is on top of things is through a well-articulated risk appetite statement, which is aligned to the stress testing results and a clear identification and explanation in the ICAP document when it comes to the Pillar 2 risks.
Thank you, Ruth. Very helpful there. There were a couple of questions that came in on the assessment of or the role of business plans and how the authority assesses them when it's undertaking its SREP. So Nikos is going to field those. So the first question, Nikos, is how do you evaluate a business plan from a regulatory perspective? And the second is whether the business plan discussion with the board members forms part of the SREP assessment.
Thank you very much, Dave. When we evaluate the business plan from the regulatory perspective, we would consider the size of the bank and market share. And when we see growth in the balance sheet, we would like to understand what are the drivers, and particularly if the growth is supported by the existing customer base and potential requirement for additional funding that they may have, or whether the growth will come from expansion to new customers and the associated risks, of course, following this expansion. All in all, we would say that we would like to understand that the assumptions that are included in the business plan are reasonable and they are justified according to analysis that has been performed. And moving to the second question, it was about SREP, I think. So yes, the business plan and the discussions we're going to have with board members will definitely fall under the SREP assessment, and particularly under the business model assessment. Although the SREP has by nature a retrospective character, we would like to see the forward-looking view of the business, and we would like to assure that the calculations performed under the business plan are credible and the business plan is reliable. We also expect that the business plan will form the baseline scenario in the ICAP calculation. So under this scope, we would expect that the changes in the risk profile of the bank have been considered in case that we see material deviation from the existing balance sheet structure. I think I covered the topics. Floor is back to Dave. Thank you.
Okay, thank you very much. Thank you very much, Nikos. Okay, there was a question that came in on stress testing, so I was just going to field the question there. So the question is whether or not a bank is required to calculate its own Pillar 2 guidance threshold. I mean, the answer is that, of course, that is a regulatory requirement, so that is set by the regulator. However, what we would expect a board to do is, through the analysis of its stress test, understand how its balance sheet reacts in either an idiosyncratic or a market-wide economic shock, and be able to talk us through how the balance sheet reacts and therefore what level of capital it believes is appropriate to hold in order to ensure that the balance sheet can remain resilient through a stress cycle. The actual confirmation of a P2G may include other factors that the regulator can only be aware of. So when we set the P2G, we will ensure that there's consistency across firms, and that those who are being conservative aren't necessarily penalised, where those who are not being conservative are not. And we will include other factors that are pertinent to the assessment of P2G. But we would expect to engage the board members in a conversation around the resilience of their balance sheet in a stress. The other question that came in relating to stress testing was the difference between a dynamic and a static balance sheet. We have noticed in a few of the assessments that we've undertaken, the boards are continuing to assume that their bank will grow through a stress, which mitigates, of course, the impact of it, generating additional revenue and minimising losses. We're not expecting boards to assume that a stress impacts others, but impacts the bank itself, and that the board can demonstrate that the appropriate and prudent assumptions have been taken about the way in which the balance sheet will react in that stress. We wouldn't regard significant growth as being a prudent assumption during the course of a stress. There was one last question which has clearly generated some interest out there as well, and that is the expectations of the MFSA of the number of hours that a non-executive director should dedicate in their role on the board of an LSI in any given week. Now, of course, it's not possible for the MFSA to put a number on this and give you an answer. There are a number of things that we would take into consideration when we're thinking about whether or not a non-executive director is devoting sufficient time to the role that they've taken on. The first, obviously, factor would depend on the business risk profile of the institution and the amount of work that is involved in actually oversight of it. The second would be the competency of management and effectively the amount of competing or compensating control that is required from the board non-executive directors in their oversight function. And the third factor would be their role on the board. Some non-executive directors will have a bigger role than others, and what we would like individuals to communicate to us clearly, but also hear from the chairman, is the expectations of each of the non-executive directors and what they bring to the board, and in an area that is important or a significant risk to the bank, then they're obviously in those areas we'd expect the non-executive directors to be more active. What we do recognise, though, is that regulatory issues are taking up an increasing proportion of board time, but that is a fact that we have to acknowledge and deal with and absorb into the way in which boards are configuring their agendas. And as such, we understand that the job is a demanding one and does require sufficient time in order to be able to discharge it appropriately. And in that way, it's important for non-executive directors to show us that they have enough time to devote to their role and can articulate to us what that is. But it's certainly the case that for for a chairman, for example, of the board, where there's a lot going on in the bank, that the role could take up quite a lot of their working week. So we understand that the time will be time devoted will have to be significant, at least for some members of the board. Okay. That covers the range of questions that we got in on our presentation. So I'm going to hand back now to the conference chair, Nick Dexter, to introduce the next set of the agenda items. Thank you.
Perfect. Thank you for that. So next slide, please. So, by way of introduction, I'm going to give a view from the UK, as it were. In my day job, I'm a senior advisor at the PRA in the UK. Senior advisor is a role which is a bit of an internal consultancy and a bit of a second line challenge role, where we advise the senior people in the PRA and the Bank of England on various issues. And as I mentioned, I'm also a non-executive at MFSA in Malta, so have a foot in both camps. This first bit, I'm just going to give a bit of some thoughts on what we've heard today, because some really interesting points, both from the FSA and from Anne. To start off with, I think David made a very good point that an NED role is not an easy role. It does take a lot of time and work and effort, and keeping up to date and keeping on track of what's going on in the business. But having said that, we did hear about the problems around poor governance, and certainly in my experience, when we do training within the regulator in the UK, we look at the cases where we've had dramatic failures in the UK, be HBOS or Northern Rock, and any number of the failures that we've had, and nearly all of them stand in some way back to poor governance. And that's why we put so much emphasis on how pivotal the role is of non-execs in firms. And in particular, I think David mentioned that the chair role is pivotal. And I think that's right. Again, I've seen in various boardrooms how much difference the chair doing a good job makes to the performance. I often say it's a bit like a football team. You know, you can have the best players in the world, but the manager, having a good manager is important, and the chair is that. And so we do look to the chairs of our institutions as being a really important role. Nikos and Ilias gave us a talk around talking a bit around stress tests and recovery plans. One of the things that we found with recovery plans, recovery plans are a difficult one for a regulator to assess, because you're always looking to identify whether the recovery plans are just theoretical or to what extent would they work in practice. Nikos talked about the challenge around whether they're effective or not. And we do look for a variety of tools to look to what extent firms have undertaken dry runs, whether they have particular dependence on third parties to make them effective, and so on. So for firms to be able to bring that to life as to how realistic and effective those recovery plans are is really important. I was particularly struck in the talk from Ruth and Nikos around 3 lines of defence. There were a number of interesting messages there, in particular about having the right quality and resources in the 3 lines. Again, there's sometimes a disincentive for firms if they were of that ilk to not put the right resources in there. Good firms do, and that really stands out. I've also struck by the points made about MI and quality of information given to the board. I remember having a lunch with one of our lunches that we sometimes have with board members, and a number of board members complaining about the quality of MI they get, be it the amount of information, and trying to sort the wood out from the trees, how indigestible it was, how complex it was. Yet actually, when questioned, many of those people weren't actually doing anything about it. So I always think it as a NED, and I've tried to do that in my role. of demanding and saying to the exec where information isn't good enough and where it needs to be improved. But I also think it's you know, I often say to execs the same thing. How often have you asked of the board whether the information that they're getting is of the right quality or of the right thing? So I think it's definitely a two-way process. Caroline and Anton gave us a good talk around risk appetite and some of the current issues. And I think risk appetite, we in the UK have been working with many boards on the risk appetites and the development. I think there was a tendency at one point to think, you set a risk appetite, then that's a done thing. I think the better boards understand that risk appetites are a journey. They need to be reviewed quite regularly. They need to be developed, particularly as risks change. And a good example is around climate change at the moment, where it's already been mentioned a few times, and I'll come back to this. But it's a good example of where we're expecting firms to develop their risk appetites in terms of sustainability and climate risks in a proportionate way for different firms. But it just shows you that risk appetites can't be static; they need to be developed. AML is always a challenge, and Kurt and Eric did a great job in talking to us about that. I think that is a real challenge for boards to really get to grips with what AML risks they're exposed to, whether there's enough resource being put into that area, where the weak points are, and that is really challenging. So I don't underestimate the difficulty that firms face in this area, and certainly I always think that independent reviews are really helpful in this, because techniques and issues are continually evolving, and sometimes it's good to get a third party in who've perhaps seen different things elsewhere, and testing out your own processes that way. And I have a lot of empathy with what Anna's just talked to us about in terms of the issues the ECB faces, with the different issues that are often local, can change dramatically from country to country, from firm to firm. So again, a journey for us to work with the ECB as they develop and issues develop over the years. Next slide, please. So why did we in the UK bring in the senior managers certification regime, which is our guidance and framework within which boards and firms, senior management of firms, are expected to operate? The need for senior management accountability is evident to well-run firms, but not always evident to the less well-run firms. And indeed, we think that introducing the senior management regime supports their success. Going back to 2008, the global financial crisis, it became clear that a new legislative and regulatory framework was necessary, in a large part to ensure that senior management could be held to account for significant business and conduct failures that occurred on their watch. So ultimately in 2016, so it took us a while to think this through, the UK Parliament introduced the SM&CR, the Senior Managers and Certification Regime for banks and insurers. Central to this requirement was that the most senior decision makers in firms should have clearly assigned responsibilities and be accountable for actions within their remit. These reforms complemented other reforms at the time, which ensure that senior individuals are also held accountable for their actions through their remuneration. The key components of the regime are outlined on this slide, but overall they give more clarity to the role and conduct of senior decision makers, both executive and non-executive, and the rules and powers of the regulators in overseeing that regime. Next slide, please. Now, as regulators, we always focus on material issues in our engagement with firms. We're not formulaic about the supervisory activity we perform, since the focus on key risks means that the activity depends inevitably on a firm's particular circumstances. Nonetheless, our supervisory work comprises a variety of possible activities, and I thought I'd expand on what we expect of boards, which is very consistent with what we've just heard from colleagues at the MFSA. As the slide says, the key areas we're looking for boards to oversee are, firstly, the development of a sustainable and clear business model, which is consistent with the business strategy. For all PRA regulated firms, PRA expects to see evidence that the board has established and taken decisions consistent with the sustainable business model. We want to ensure that firms are managed in a clear and prudent, with a clear and prudent strategy and with a clear risk appetite, and ensure that the firm meets its regulatory obligations. We think the business strategy should be supported by a well-articulated and measurable statement of risk appetite. This should be expressed in terms that can be really understood by employees throughout the business. The risk appetite should be clearly owned by the board and be integral to the strategy the board has signed off. It should be actively used by them to monitor and control actual and prospective risks and to inform key business decisions. All directors should have the time and opportunity to contribute to the development of the risk appetite and to provide appropriate challenge before final approval by the board. The PRA expects to see evidence of the active oversight of risks according to this risk appetite, and the risk control framework should flow from the board's risk appetite statements. Now, it won't be a surprise that we also expect boards to be open with us as regulators. We expect the board to develop their firm's culture that supports the prudent management of the firm, and that means the board should articulate and maintain a culture of risk awareness and ethical behaviour for the entire organisation to follow in pursuit of its business goals. The PRA expects the culture to be embedded with the use of appropriate incentives, which includes but is not limited to remuneration. And we expect the board to encourage and where necessary require the behaviours they wish to see, and for this to be actively overseen by the board. We believe that non-executives have a key role to play in holding management to account for embedding and maintaining this culture. Next slide, please. Now, since the implementation of the SM&CR, firms and regulators have gained considerable experience of how the regime works in practice. To make sure the SM&CR is delivering against its original objectives, the PRA carried out last year an evaluation to assess progress and to see if any further action was necessary. So I thought it would be interesting to take you through some of the results of that exercise. Now, it was notable that 97% of firms reported integrating to some degree the SM&CR in their business as usual practices in ways that went beyond the simple requirement to demonstrate regulatory compliance. So that was quite encouraging. Some firms provided specific examples of how the SM&CR had prompted improvements in internal processes. For example, better handover arrangements between senior staff, improved clarity of board responsibilities, and improved compliance and ethics training. Results from the survey showed that 94% of senior managers and 96% of firms that responded reported that the SM&CR had brought about positive and meaningful changes to behaviour. Some respondents who did not attribute improved behaviours to the SM&CR said they had already placed considerable emphasis on individual accountability anyway, and therefore the additive effect of the new requirement was not material. Next slide, please. Now, the requirements of the senior management regime exist alongside the statutory and fiduciary duties of directors under UK company law, as is often the case, and the relevant corporate governance codes. The responsibilities that exist under the senior management regime are designed to be additional and complementary to the duties that directors have as members of the board. This reflects that while boards are responsible for the strategic direction of the firm, they are reliant on its senior executives to implement their decisions and to provide them with information. In the past, some observers have asked if a requirement to specify individual responsibilities actually undermines the collective responsibilities of the board. Results from the survey showed that the respondents found that the SMR does actually complement board responsibility. Nonetheless, a few survey respondents reported some tension. In addition, directors have in the past expressed concern that the SMR might actually encourage two-tier boards, given that not all senior management functions are treated in the same way, although the PRA has not actually identified any trend in this direction. Next slide, please. Now, proportionality is always an issue. In the UK, we've got a mass of different sizes of firm. And here, the slide has got different sizes of firms. So category 1 on the left hand side there are the largest firms, with the smaller 2, 3 and 4s. And you can see there's a pretty consistent response. We believe that the regime does need to be sufficiently adaptable across both banks and insurers. It needs to apply to large international firms and smaller domestic institutions, and it needs to apply to a range of foreign branches operating in the UK, as well as to both mutual and non-mutual firms. Our supervisory statements note that in assessing whether a senior manager has taken reasonable steps, the PRA may take into account of the size, scale and complexity of the firm, and whether any delegation in functions has been appropriately arranged, managed and monitored. The majority of firms surveyed felt that the SMNCR was proportionate, but the fraction expressing a contra view was higher among the smaller firms, but the difference wasn't too great. Next slide, please. Now, as I said, one of the features of the SMCR is individual accountability. When asked to highlight changes in behaviour that have stemmed from the introduction of the SMCR, many firms said it had resulted in clearer articulation of authority and had improved the focus on accountability and responsibility. 94% of firms found that at least occasionally the SMCR had helped hold individuals to account. So again, that's an encouraging result of introducing the regime. Next slide, please. A majority of firms had found it helpful for the PRA to introduce the requirements and the guidance for new and evolving risks, noting that it did bring increased clarity, particularly in relation to the regulator's expectations. Some firms noted that they would benefit from the regulator applying this in a more consistent way, supported by a central repository of new requirements for their reference. Now, our view is this: there's always a trade-off between a principles-based approach and having strict rules. We think that allowing some latitude to firms with how they implement the regime is a better and a more proportionate way than having various detailed rules which give certainty but may not always fit the structure and culture of every firm. So we believe our approach is working in that respect. Now, no, sorry, next slide, please. Now, the final slide I've got from the survey looks at how different areas of the firm have been affected by the SMNCR. We were pleased to see that generally the impact of the regime has actually been positive, albeit that we will be looking into the areas where we've had some negative feedback. We think this does agree with the general feedback we do receive from board members, that the clarity of what is expected of them, together with the support of the regulators, has generally helped boards in their work. The biggest impact would appear to be on retention of staff, where we have heard it said that staff and board members may actually opt out of working for regulated entities because of the stresses and strains of being under the senior management regime. Particularly, and one of the particular areas is on remuneration. But on the other hand, from this slide, recruitment has seen less of an impact, and this is consistent with boards telling us that there is actually a good supply of senior people in the industry, and they are actually, having worked for their career in a regulated institution, are quite happy to continue post executive retirement by working on boards. And therefore we're overall comfortable that is a good result. We do recognise that there are specific problems in recruiting, for example, board members with cyber experience or something like that. But that's I think there's as a general lack of expertise in the industry generally in that area, and there always will be in fast developing areas. And climate is another one where the requirements are moving quite fast. Next slide, please. And this is my final slide, where I thought I'd just talk a bit about what this does mean. Having talked about the senior management regime, how do we actually interact with firms? And as I said earlier, I think that a lot of what we're doing is very consistent with what the MFSA is planning to do. we interact with boards in a number of ways throughout the year. In our close and continuous supervision, we do have regular dialogue with boards. That may be the board as a whole. Sometimes we'll have meetings with the boards excluding the executive, so just the non-execs. So that enables a slightly different conversation. We do have meetings both with groups of board members and of course with board members on their own. And indeed, typically we would have a program of individual board meetings, and nearly always we would meet regularly with the chair of the audit committee, the chair of the risk committee, and quite often other board members as well, as depending on what's going on in the organisation. But certainly the chair and the chairs of audit and risk are pretty high up our agenda. In our approach to supervision, we have a particular score that we give on the quality of management and governance in firms. So we regularly do on-site visits and looking at management and governance, as well as obviously looking at doing desktop reviews in terms of board papers, board minutes, and so on. But we do put a lot of emphasis on and a lot of weight on face-to-face meetings, or at least conference calls at the moment, but face-to-face meetings with the board directly. Sometimes we will do board observations where we will sit in board meetings, not being active members. You know, we do obviously go to board meetings to present reports and on visits, but we sometimes will do board observations where we sit in the background in board meetings just to see what the dynamic is in the board meetings, because we feel that we really get a feel for the dynamics, the conversation, the degree of challenge by sitting in boards or board committees. And that is a key part of the work that we do. And indeed, people like myself assist supervision in doing those sorts of visits, given our experience of being in the boardroom. But we do other things to interact, because I think, as someone said earlier, the importance of two-way conversation with the regulator is really important. This isn't all about the board supervisors oversight. This is about a two-way dialogue between the board and the regulator. So as part of that, we have in the past had roundtable lunch sessions. So these work that we say have a meeting of, say, chairs of remuneration committee, chairs of risk committee, and get similar people from different firms around the table, just to talk about current issues, things that affected them, which enables a two-way or a three-way conversation, two-way between the regulator and the people attending, but also in between the different members there to talk about issues and what's working for them. And people have found that really helpful in terms of being able to share experiences with people in a similar position in different firms. We have annual NED conferences. So again, a bit like this call today, we regularly have conferences for non-exec directors for a similar reason, which enables us to talk to, communicate our view on breaking emerging issues, enables the non-execs to quiz members of the regulator. They have direct access to our CEO and to other senior members of the regulatory team, and as well as talk amongst ourselves. So we've had some really good feedback from what firms have got out of those conferences. So we do those every year. We also do other ad hoc things. For example, we this is the senior advisor team at the PRA, being independent of supervision. We had a series of meetings towards the end of last year with around 40 firms to talk about emerging issues, current issues. Again, to exchange ideas, to change what was concerning them, as not just talking about their firms, but talking about the industry in general, both banking and insurance, which again was a very useful exercise of pooling that sort of knowledge. Certainly keeps us more up to date with what's actually going on in the industry, and getting direct feedback of the business issues that they face, which enables us to have better insights and to tailor our agenda. Thank you. That was my last slide. So thank you for that. So I think now we are moving on to the the Fireside chat session. David. Thank you. So in our next session, we've got some questions that have been submitted, and we've got some prepared questions as well for me to ask of various people. So we've got David and Anne, who just spoke before me, but we've also got joining us two other experts who I will just briefly introduce. So firstly, we've got Christian Fruga. Christian is a lawyer by profession who has been practicing law since 1988. He's a founding partner of Fenech Fruga Fiat Legal and specialises in law, M&A and financial services. He's currently the appointed chairman and NED on the boards of a number of MFSA regulated entities, including Mercanti Bank PLC and Advent Insurance PCC Limited. And then we've got Lara Casar. Lara was appointed to the board of directors of APS Bank in April 2016. Dr. Casar has wide experience in many areas of practice, including banking, investment services and asset management. She was formerly a partner at Camilleri Preziosi and in 2015 moved on to establish the firm Camilleri Casar Advocates. She's also a NED on the board of Hilly Properties PLC and NED and company secretary on the board of MedServe PLC. So welcome to Christian and Lara. Different role of the non-execs and the executive. What do you think the relationship of the board with the executive team should be?
Hi, and first of all, thank you for the introduction, Nick, and I think I commend the MFSA for starting off an initiative of this nature. I think it's extremely useful. So getting to your question, I think there are two areas which I see as being extremely important, and those would relate to the non-executive directors, I believe, providing support to the executives. So where there are certain decisions that need to be made, it's the timeliness of decision making by the board. It's the forthright principle as well, because the executives also rely on the board having a different perspective and giving them the necessary leadership, I would say. But it's also important to challenge, as has been mentioned, that we need to be there asking the uncomfortable questions and thinking outside the box and challenging them in terms of not necessarily questioning under a bad light, but putting your impetus into it and not sort of blindly relating to sort of blindly ignoring what your role is. But I think all of this requires trust. I think when you don't have that element of trust with your executives, all of this challenging and control that you put as a non-executive director on the board can create an uncomfortable situation, I think, with your executives, where they feel that they are being channeled too much, and you're sort of overstepping your line, and I think that can create an uncomfortable situation in terms of your relationship. So I think that if the trust and the relationship with the executives is key, you need to, and I'm very happy to have heard Anne's comment before, where she hasn't really come across any situations where they really have overstepped into executive shoes, because that is a really difficult one to keep in mind. You know, if you're there sitting and you need to question the detail, at one point you do question yourself: am I overstepping the line? Am I actually taking the executive decision? So these are really interesting points, and I'm happy to hear that, because it substantiates the role of a NED on the board, actually asking the questions, being the uncomfortable one in the room, sort of thing. I once read an article saying that if you sitting back in a board and waiting for your first year sitting on the board to absorb and to start giving feedback, then you shouldn't be on the board in the first place. Those people that are coming in and being a little bit difficult and making your presence known, and not simply asking to ask a question, but because there is a fundamental reason for it, and because it needs to fit in with the executives' strategy and your strategy of the bank. You have to live the values of the bank together with the executives. It has to be a team effort, because otherwise, if you don't do that, you will always end up having a defensive team. They will not provide you with the information. It needs to be an open and honest relationship working towards the one goal. And I think that is really crucial.
Thanks, Lara. Yeah, I think it's a really interesting point. I certainly remember sitting in one of my board observations and seeing a situation where the chair and the CEO were obviously very, very close, and the chair virtually shut down any challenge from the other board directors. So we certainly saw some pretty bad behaviour on that case, and we managed to get that chair removed eventually. Because it was clearly that the board wasn't doing its job, but as you say, the majority of cases that isn't the case. So thanks for that. So given that, David, perhaps I can move to you, and I'll ask Anne the same question after you've had the chance to answer it. How do regulators ensure their expectation of NEDs are applied proportionally?
Thanks for the question, Nick. Yeah, I mean, it is a challenge for regulators. If you have applied for a banking license and you're running a bank, I mean, any financial services license is a very valuable thing, but the banking license means that you've got to have appropriate oversight of your business. So there's a sort of a de minimis level of regulation that goes with that, commensurate with the responsibility that it holds. So what do we do though? The frequency of our assessments differs according to the size of the bank. So as you heard, there's a distinction in the LSI population between LSIs and high priority LSIs. We have a 2-year framework here in Malta for the sort of application of our regulation, which means there's a sort of a more intensive year for each bank, but 1 year where there is much more of a focus on delivering the agenda and ensuring that the actions that we've set have been collectively have been implemented. But there's also, and for the significant institutions, as you heard Anne say, that happens every year. There's also opportunities for us to speak to banks, and we do that to ensure that we spend time explaining what it is that the regulatory requirements are, and we do that more with banks that are smaller than we do with larger ones, where we would expect them to be much more on top of their game. But I would also just want to perhaps emphasise in this question around proportionality, because it was raised recently as well in a visit by the Supervisory Board Chair, that actually, we can be sort of quite proportionate if we think we've got a board that understands the risk profile of the institution that it's overseeing, is holding management effectively to account, and we can see demonstrating the right kind of behaviours. That gives us confidence, and I think Anne spoke to this in the way she answered a previous question, that the board is executing against its mandate and representing the wide range of stakeholders that there are with an interest in how well the bank is run. And we can be sort of less intrusive and intensive in the way we regulate, where we can trust the board to get on with the job, and that doesn't really depend on size, but on culture and attitude.
Great, thanks. Okay, now one of the things that we often hear of is the potential for conflicts of interest for non-executive directors, and I wonder if I could ask Christian to talk about what NED in your experience NEDs can do to manage conflicts of interest, both perceived and actual.
Firstly, Nick, thank you for the introduction too. Conflicts of interest have been around for quite some time. We know that the principle itself was also recognized and regulated even in the Companies Act. So it goes back to 1995. So, you know, issues relating to the management of conflicts of interest aren't something new. Certainly, the issue takes precedence, and I would say takes some significance in the context of the banking industry, because we do know that in the case of potential breach of a duty of conflict of interest, of disclosure of conflict of interest, there could be severe harm caused not just to the bank, but also to the clients, customers of the bank. It could affect the public's trust, the regulators' trust in the bank itself. So it is clear that banks have to give conflict of interest policy utmost importance. And my experience and knowledge is that most banks in Malta, I would say all banks in Malta, apply a conflict of interest policy quite widely and properly. What would an NED do in order to try to manage a conflict of interest? I would say the answer is two-pronged. The first is there are personal initiatives that an NED should take in order to address possible conflicts of interest. In other words, he has to be very much aware of what the conflict of interest policy of the bank is, where conflict of interest may arise. He's got to be vigilant to ensure that if there are any developments within the bank, in its business, its client base, he responds accordingly and discloses that conflict of interest, as he should. And moreover, ensures that if any conflict of interest were to arise, he's fully transparent in the detail, not just on a general level, but also in the detail as to what conflict may have arisen. That's in order to put the bank in a position to address any harm that could have been caused by that conflict, or to prevent that harm from happening in the first place. So that's the first problem, if you like. The second, I think that every NED also needs to be vigilant of the possible conflict of interest of his peers, the other members on the board. There have been situations, not in the banking sector, where I have been involved professionally, where conflicts of interest arose on the part of a director, were not disclosed, and nobody did anything about it, even though the other directors knew and could have reported it. But I think, given the fiduciary obligations that we have as board members, we also owe it to the board to report any conflicts of interest that we see, real or perceived, that we see or that may arise in the case of other co-directors or senior management of the bank, for that matter, not just at board level. So I think the issue of when a conflict arises is usually pretty clear, but it's not always that clear. So this is what I would say is that there are three words that we need to keep in mind as NEDs when we apply ourselves to addressing conflicts of interest. One is awareness, second would be vigilance, and the third is full transparency. We really need to be transparent in everything we do here. And that is the way I think that we can manage it. We do know that banks have conflicts of interest policies. That's the easy picking. It's the implementation of the policy which is the challenge. And at the end of the day, I think a policy, a conflicts of interest policy, is as good as the director's commitment to endorse it.
Thanks, Christian. Yeah, I agree. Certainly, in my experience, having a policy is a good first step. But as you say, implementing is the key thing. And I've also seen it conflict of interest policy being implemented where it's almost to avoid having to do something more difficult. I can think of a recent case in the last year where there's a regulator, we wanted a firm to restructure in a particular way because we felt there was a conflict of interest and the firm wasn't happy. So they said they'd implement a policy. and we felt that actually a cleaner thing would be not to go in that particular direction in the first place, to avoid the conflict rather than trying to manage the conflict, having compromised the situation. So yeah, I agree, and clearly transparency. So thanks for that. Now earlier we had quite a good session, a very good session on AML and the risks that are there, and the challenges for boards. So I wondered if I could ask Lara to talk about how boards can actually get comfortable with AML risks in practice.
Sure. Well, it's not one of the fun areas to talk about, I would say, and it's useless ignoring that this has been absolutely that this isn't become one of the most important areas actually, and in particular having sort of noted the liability also attached on board directors in relation to AML matters is huge. So this is there's a personal interest, apart from obviously the interest of being a director on the bank, to ensure that AML issues are given the necessary importance. And again, sitting in the NED position where you are not in direct control like a CEO would be, it would be imperative, I think, as first and foremost, to ensure that you are comfortable with your staff. So the very people that you place reliance on, you need to be comfortable that they are knowledgeable and that they are skillful. If you're not going to have somebody who has the necessary experience and expertise and seniority and gravitas when it comes to pushing the message down through the various channels at the bank, which obviously from an AML perspective can really go down to all tiers of the bank, then you're not going to have the necessary protection. So I think first and foremost, it is crucial that the banks, the NEDs, actually feel comfortable that the people that they have recruited in those roles have the necessary expertise and knowledge. It's not easy to find. I think this was highlighted earlier on. There is a shortage of these people. The AML is an issue not only for banks. It's an economy-wide risk. So you are not only competing with other banks for these specialists, but you're obviously competing with the industries in general. So that also means that you have to put money towards it. And like in every other control function, where you have a strong demand for these people, it is natural that it's going to be an expensive, but obviously, no doubt, well worth it investment. I think adding on to that, it is important to have strong internal control. So having the necessary controls that go hand in hand with the AML specialists and the AML controls within the bank, to ensure that the necessary processes that are being put in place then have their own testing systems with internal audit and other control functions. Again, a very, very hefty cost, but an investment in IT systems that is crucial in this day and age where these criminals are far more savvy than the man in the street. So the banks have to be well ahead of their challenges in this respect. And I think lastly but not least, I would put an extremely big highlight over having an informative regulator, which is not to say that we don't have one, but I think in the past, this has been an area that has been neglected throughout the system. And now that over the past years, we have seen that there has been given importance to this area, there needs to be a continuation, I would say, of this type of knowledge spreading. I think that is crucial. I was really happy to see how you, Nick, mentioned the way that the interaction with NEDs takes place generally, obviously not from an AML perspective, but having informal chats with your regulator, in my opinion at least, gives a hell of a lot more feedback and a hell of a lot more, what can I say, results from the more formalistic approach and the more supervisory standard channels, as one would say. There's possibly a difference in styles as well. Sort of the British style might be a little bit more informal when it comes to these in the interaction. But I think it is. I think when people are sitting down, having conversations and talking about certain issues with their regulator as a peer rather than as a boss, I think you get a lot more out of it, and one can really sort of feel and understand the supervisory priorities and how they impact your very own institution. Because having an AML issue for a bank that deals solely in high risk areas from an AML perspective is very different to one. I'll give you an example like APS, which has the vast majority of its portfolio in Maltese home loans. So I would say that that's sort of one of the major ways that you can have an NED feeling comfortable that they can then ask the right questions, because we also mentioned that the NEDs are a lungomanis, if you like, of a regulator. You have the same priorities to a certain extent. And I think working hand in hand with the regulator will serve the purpose much better.
Thanks for that, Lara. Christian, I wondered if you'd got any thoughts on this one.
I think Lara covered most of the answer. However, I think the basis of an AML infrastructure needs to be underpinned by having the 3 lines of defense really properly and solidly set up. I mean, this is the basis of the manner in which AML practices need to be organized at every bank, and this requires a lot of investment, not just in human resources, which we heard before are not always easy to come by, but also in an infrastructure, an IT infrastructure, which would assist the lines of defense in what they do. I mean, I think we've all seen certain developments in IT processes in the last years, which were not available in the past, but which have really helped in strengthening the infrastructure, the human resource infrastructure of our banks. Now, these are expensive, as Lara said. They take time to put in place, and they are continuously evolving. I mean, I think the IT systems that we have in place today will probably see significant changes in the years to come, which would ease the pressures on all lines of defense in properly implementing AML policies. The risks for NEDs are significant. I think every little penny which is spent on human resources and in a solid IT infrastructure and its development, I think is worth investing, because at the end of the day, it's the board members who are taking personal risk for things that can go wrong, but it's also the bank itself. And I think no bank wants to be faced with a situation where, because of a possible AML breach, it ends up not just suffering reputational damage, but also financial loss. I think this cannot be overemphasized. We know that in the last years, AML pressures have been significant. We've seen, as Lara said, we've seen a certain spurt of activity in the last years with a focus by the FIU on banks and other regulated entities, and that's all well and good. I think that we have also learned quite a lot in this process, but if the process is to continue and continue always within the context, within the environment of a thriving banking sector, of thriving financial services sector in general, it's very important that the regulator and the sector and the industry are in open discussion on a continuous basis. The conversation has to be proactive, but also constructive. One of the worst things that could happen to an industry like this is for a regulator to take a destructive approach. When I say that, I don't mean it as intentionally destructive, but to take a bit of a rushed approach, which leads to the industry players suffering, both in terms of their organization as well as in terms of financial expense.
Yeah, thanks for that, Christian. No, I agree. As you say, it's always a challenge for regulators to minimize in some way the risks, but at the same time not, as you say, destroying the industry. Clearly, the best way of managing, for example, managing any risk is to not take the risk in the first place, but then you don't have a market, which is again unacceptable. So how do you optimize that is always a challenge. And I think the other reaction that I've had, I'm always interested in fintech because it's such a developing area, and we've all seen the discussion of how these sort of risks like AML can be enhanced by using artificial intelligence. But then as board of directors, we can get comfort that we've got smart AI systems, but then we've got to worry about the risks of AI and how much can we believe what is it that the AI isn't doing, or what is it doing unintentionally that we didn't think we got. So as always, that universe of risk, we get rid of one risk and we invent another risk. But that's both the tricky bit and the interesting bit, I think, of the market that we're in. So yeah, no, thanks for both answers on that. The next question I got, which is one that I've been challenged on in meetings with boards many times, that the pace of regulatory change and regulatory development is ever increasing in all sorts of ways. So is there a risk that NEDs end up spending so much time on regulatory compliance that they actually don't have enough time to properly consider the other business issues that their firms faces? So if I can, Christian, come back to you again and ask you first, and then I'd like to get a reaction from David on this one.
As far as I'm concerned, I think the simple answer to that question is yes, the risk is there. I think I have seen this evolution myself over the last 10 years. I've been involved with Mercanti Bank and its previous name for long, and I have seen that the amount of regulation and the cost of regulation on the bank, and I would say with all other banks in Malta, has been significant. I don't think I'm disclosing anything when I say that most of the board agendas today taken up by addressing regulatory matters. This is both in terms of regulatory compliance, review of reports, and this is reflective, I believe, also of the effect of regulatory compliance even at management level, at executive level. There's been a paradigm shift in the way that regulated entities such as banks have had to deal with regulation. Some would even argue that this is over-regulation. We've had this discussion time and time again. But at the end of the day, regulation is here to stay. Call it whatever we want. We can call it over-regulation, but it's there. It's a reality of life which we need to adapt to, and not just. My wish is, I guess it's a wish shared by most NEDs, is that we would be able to flourish in an environment, this type of regulation. How do you do that? It's not that easy, because a bank's focus must also be on business initiatives, development of its business. There has to be that element of focus on business development, which allows the bank to do what it is out there to do, to generate revenues, make a profit, and run its business in the future. So I think it's a very difficult balance. But at the end of the day, I sincerely believe that with the right level of investment in infrastructure, and that, of course, we're combining here human resources and IT infrastructure. I think the NEDs will be relieved, boards will be relieved to spend quite a lot of time, I would say, perhaps start focusing on business development, business initiative, business opportunities as they should. And this is something, you know, if I look back at my own experience, I think over the last 3 years, things have already taken shape in that direction, in a way that things are always more difficult at the beginning, but as we adapt, as we get used to and learn the processes, we get better at it. And this is a question of ongoing, of course, also ongoing education, training of staff, but not just of staff, even of NEDs themselves. I think this is, my opinion, one of the crucial elements of the development of any institution. And there has to be ongoing training, ongoing education, in order for things to move in a much smoother manner. And that's the way we can adapt.
Yeah, before I get a reaction from David, perhaps can I ask you a follow-up question, Christian? And I mean, are you seeing any trends in more board meetings or longer board meetings, or possibly more stuff being pushed down from the board to board subcommittees? Are there any moves in that direction?
Definitely. I've seen this happen. It's not just a question of the length of the board meeting, but also the delegation of certain discussions to the subcommittees. So the frequency, not just even the length of the agenda, is reflective of these regulatory pressures. I think is the way that we can handle it. But if you ask me whether it is overbearing, in terms of the organization of these meetings, I don't think it's too much. You know, it's something, in other words, that, as I said before, we need to adapt to, and we're doing it, and it's happening. So if meetings, due to perhaps the introduction of further regulation, if they need to be held on an even more frequent basis, then so be it. And that ties up to what I believe you were saying, Nick, earlier. It's very much a question of the dedication of time. Then, you know, you cannot have any NEDs who do not have sufficient time, energy to be able to dedicate to those meetings. So I think every bank has its different requirements and different situation. So there are big banks and smaller banks, but regulation is there for all, or at least for most regulation is there for all. So you've got a situation where even if you are a very small bank and you may not have, you know, the hundreds of clients and customers, you still need to go through the loops. You still need to comply. You still need to prepare the reports and then discuss the reports and have them approved. So at the end of the day, each bank will be able to dictate, the board will be able to dictate what frequency and what level of depth the meetings have to have. But I think there's still going to be quite a lot of this, and there has to be a lot of dedicated time by the NEDs and board boards to that agenda.
Great, thanks. So, David, can I come back to you on this and sort of get your take on it? You know, where are we going in terms of getting the right balance?
Yeah, so it's an interesting question. Let me explain why I don't think regulation necessarily is crowding out business development. I mean, what are regulators interested in? We're interested in ensuring that there are sustainable business models, both supported by both predictable revenue generation where that's possible, and an appropriate assumption about the sort of costs of running the business. What is it about that a non-executive director wouldn't be interested in ensuring? We're interested in appropriate controls to mitigate the range of risks that we've talked about, whether it's AML risk or others. again, a key focus of the non-executive directors. We're interested in making sure that businesses are sustainable through an economic cycle, and indeed what board wants to oversee a business that would be a risk given that events can occur. And we're interested in boards that are ensuring that there's an appropriate culture for the treatment of customers, so that customers have a positive view of the relationship of the business that they're doing, or the bank that they're doing business with, and indeed that contributes to more sustainable customer franchises in the medium term. And when it comes to business development, whether that's customer acquisition, or indeed product governance and the way in which products are developed, that should not, ensuring that the banks that are developing those products are doing so in a way where they recognise the additional risks or the change to the risk profile. Again, what about that the non-executive director wouldn't be interested in? So I'm not sure I see the issue in the same way, that regulation is crowding out other things. What I do see is that some banks don't make some of these things the heart of the regulatory aspects, the heart of their business. So those banks or boards that start with a sort of position that the ICAP is a regulatory document over there, separate from the way they run the bank. That's something for the regulators to have, and if they could just have it and get on with it, and we can get on with running our bank, that would be great. I mean, culturally, that they're operating in the wrong space. The ICAP is a mechanism that directors and non-executive directors can use to show the regulator that they have a good understanding of the risk profile, that they've invested a sort of intellectual energy in analysing the risks that are posed and the appropriate controls, and that they have engaged their management teams looking at the sustainability of their business flows. So these things can be used as vehicles to demonstrate the alignment between what the regulators are trying to achieve and what the non-executive directors' responsibilities are. And I mean, I think Anne picked a figure of around 80% where there's going to be overlap. So I think, I don't see us crowding out. What we should acknowledge, all of us, is, as I think Christian said as well, the regulatory environment is becoming increasingly complex. We're having to retrain and understand new risks, whether that's the increasing importance of IT systems and operational risk that comes with that, whether it's the cyber issue, whether it's risk posed to business models by climate change. As regulators, we've got to continue to relearn in order to be effective in our roles. Management and staff within banks have to, but non-executive directors will too. I mean, I look forward to the time when a non-executive director sort of sits in front of us in an interview and says, well, yes, I went and retrained in an area that was a developing risk, because that's something that we needed to ensure was central to the way in which we understood our business, and we developed the quality of governance on the board by ensuring that the board retrained at the same pace that the bank was, because, as we've said, the skills aren't going to be out there to buy in all of the time. So I think in that increasingly complex environment, we all have to recognise that this is demanding, but we're in an industry where that's expected, and I think Christian said it's not going to go away. So learning how we're going to deal with it most efficiently and effectively, and ensuring that our relationship with as a regulator with the non-executive directors delivers as much alignment as we can, will give clear direction to management, and I think provide for sort of a much more harmonious integration of regulation into the way boards operate.
Great. Thanks for that. Now, both of you mentioned in that response the issue about talent pools, and I'd like to pick that one up next. And I appreciate that. I was going to ask you a different question, Dave, but I'll pick this thing up on talent pools first, and I'll come on to back to Christian and Lara for their responses on One of the questions we've been asked is that there are professional led serving a plurality of entities. How will the MFSA ensure that standards are really maintained and that NEDs walk away from their current tick box approach? So on the other hand, that's saying, well, you've got in inverted commas professional NEDs out there on boards of many companies, but possibly the flip side of that is, have we got the right talent pool to introduce new blood, new? And you talked about diversity in your introduction earlier. How do we make progress in that area? So perhaps if I can go to David first, and then I'll see if Christian and Lara have got any thoughts on this.
Thanks. Yeah, I mean, I deliberately refer to that point because I think it's an important one here in Malta. If we want a thriving and developing sector, then we're going to have to develop the talent pool, and that means thinking about succession planning at board and senior management level. Now, in terms of the way in which we look at this, well, what's to a degree you could be fairly high level and say, well, what's good is what works. If somebody is good at their job, as they're a good non-executive director, they are able, as Christian was talking about earlier, to manage the conflicts of interest that might arise. We sort of have to recognise that in a small community, they're more likely to than perhaps elsewhere. We're going to have to sort of think about the risks of groupthink, though, and make sure that we bring in new people into the talent pool in order to help mitigate that risk. I mean, one of the sort of things that sort of worries me sometimes when I'm talking to board directors is when you see a very clear alignment with the management team and no sort of self-reflection on behalf of the board members around this is how we arrived at a sort of a common view. There were these challenges, there were these issues. This is the conversation I had with the CEO or the finance director about delivery, and but here's where we finally landed. But I hear sometimes a sort of, the management team's got this under control. We're not at risk, and I think when I hear that, it kind of says to me that there's not been enough diversity and challenge in the board meeting, because that clearly can't be the case. These are complex issues. There isn't from a sort of a perspective of regulator going to be an obvious answer, and we're not necessarily looking for somebody to demonstrate to us that they've got the answer, the right answer. We're asking for board members to demonstrate to us the right degree of reflection and indeed self-reflection on behalf of the institution, and that comes from having a sort of a diverse set of people involved in the oversight of the institution. But if there are people in that talent pool that are operating across different institutions and they're doing it well and can demonstrate to us that they're doing it well, then I don't think that in and of itself is a problem, providing the conflict of interest that arises between being on business models of exactly the same type of firm are appropriately managed. That's a bit harder, but I think we've got enough diversification within the banking sector in this economy that means that people could be on more than one board without necessarily that being a direct competitor of it, or the two being a direct competitor of each other. I'll perhaps leave it there and see if anybody, you Nick, want to ask me to follow up on any particular points.
No, I'll come back to let's go. I'll just see if I pick Christian and Lara's brains first on this issue. How do we get the new blood? What is it that we could be doing more of to encourage or find people to come onto the boards to give that diversity? Perhaps Christian, you go first.
Okay, I mean, the answer ties up also to what we mentioned before. I think talent pool does exist. I think there are very well educated, trained resources in Malta to be able to take on roles as NEDs of banks. The question is whether those resources, those potential NEDs, will be happy to step into an industry which, as we were saying before, presents a certain level of risk nowadays. to the NED, and time requires quite a lot of time dedication. So that doesn't necessarily whittle down the talent pool drastically, because I'm sure that there will be many people out there, many resources out there that would be interested in stepping into the role. But it is obviously a challenge. Question is, for instance, whether an NED of experience and knowledge can take on several similar positions, not necessarily clearly in the banking sector, but being an NED of a bank, NED of other regulated entities, could create certain strain on the NED to a point where he will not be able to take on one position, and that his decision might be to step out of the banking risk. So what can we do? The answer, what can we do? Clearly, this is not something that can very easily be managed. There are issues relating to the compensation that is given. That is something, of course, each bank will have its own remuneration policies vis-a-vis its NEDs. But that is something that, of course, will very much incentivize an NED to take on a position with a bank. But more importantly, I think an NED would be more encouraged to take on that position if he understands that he is supported by a good, solid infrastructure. Stepping in to a role which has its risks must mean that the risks that are being taken on are also managed, are also mitigated by a good infrastructure which a bank invests in. And that, I think, is one way how we can improve the availability of talent pool. Education, in terms of education, there are a lot of ideas that we can put forward. And this conference itself, if it is going to be an annual event, is a very, very good starting point, because it means that apart from the discussion and the knowledge sharing, it means that there's an element of ongoing training, even by virtue only of having these type of conferences. So, I think that this all supports the talent pool that exists or could exist in the future. And I believe that some emphasis needs to be given to that level of training and mentorship of NEDs and new potential NEDs in the future.
Great. Thanks for that. Lara, you got any thoughts on this?
Okay, it's hard being the third person to answer this question.
I know, but I'm sure you've got some very good points.
Yeah, I need to be extra creative. So the 3 points that I would possibly repeat relate to additional training. I think these initiatives and any other initiatives on the basics of banking in some cases, because I think one of the things that is becoming more and more obvious is that we need to, in a sense, open our minds to what one would normally traditionally consider to be a typical candidate for a bank and director. So would you be thinking of your retiree who's been in the banking industry and comes with a wealth of knowledge in the banking framework, or would you be thinking of a millennial who's starting off a business and has all the energy and knows the segment of the economy which is up and coming and maybe more in tune with IT and AI, but doesn't have much banking knowledge? So it's also a question of opening up the minds to understand, both from the regulatory perspective, whether the regulator would consider having someone like that as acceptable to the board, presumably on the basis that there would be training made available to this person to bring them within the realm of banking, sort of a non-banker to the banking board. And it also becomes even more important when we start talking about all the collective skills required at board level. The pool is what it is. You have to start looking outside of Malta, I think, in some cases, when you're looking at issues on sustainability. If that sustainability expertise that you require at board level also has to have banking expertise, it's not easy to find these people. So do you mix initial training with somebody who has the expertise in sustainability? Is that an acceptable framework to the regulator in accepting that individual? If so, then that would be one of the ways of increasing that talent pool. And another point to mention is what Christian also mentioned himself in terms of remuneration. I mean, many times, I'm not saying you do it out of as a voluntary contribution to the economy by having sort of doing it for God and country, but when you consider the level of responsibility and the input that you have to give in having monthly board meetings, you have obviously preparatory work, you have committees that you sit on, committees that you chair, there's background reading, there's training, there's a hell of a lot to do. And having this put in for the odd 20, 30, 40,000 euros that you get every year, when you also have to consider the other roles that you need to step out of because, as was mentioned before, conflicts, because you're limited in your time, it all becomes even more challenging to find these people. So as an industry and as a shareholder base, they need to consider that this is money well spent when you're putting your money towards having good directors on the board.
Yeah, no, absolutely. Now, there's a couple of points there that, you know, I think the remuneration point is a good one, because he's getting that balance right between paying enough, but without it being egregious in some way. And I think that is an issue. And I think the other point which I'd react to in my experience is this point about proper succession planning. You know, yeah. we've got it's an explicit requirement or expectation of the chair of the board in the UK corporate code about development of the board, including proper succession planning. We continue to be disappointed as regulators that firms are surprised that a board member might leave suddenly and they've got no backup plan of who might succeed as chair of risk or whatever. Whereas the better boards, you know, bring less experienced people in but they explain to us when, you know, if we have to interview them that they are bringing them in because they've got a 3-year plan of getting them up to speed to become the chair of risk or chair of audit in 2 or 3 years time. So I think some boards are really good at that and other boards are not so good. We'll put it that way. So just one for, and again, something we just touched on. I thought, Lara, you'd probably have some good views on this and on the diversity issue. What you know, how in your experience, can you sort of just talk about the importance of diversity on boards? Yeah, sure.
I'm probably the epitome of diversity.
Well, exactly.
I'm representative of a minority. Yeah, I think it is imperative. Not because I like flying the flag of female representation. I actually detest that argument because it sort of puts you on a pedestal, not based on competence but based on gender, and that's a discussion I absolutely hate. But having said that, it is a necessary passage that each country needs to go through, and I think Malta in particular. But diversity is not only about gender. We obviously Correct. All know that, but it's a question of backgrounds, it's a question of age, it's a question of experiences, and I think having a diverse board in all of these elements has the added benefit of eliminating also things like groupthink. We've also mentioned this, but if you're sitting around the board with 8, as I mentioned, white male retirees who are in the banking industry in Malta, there's much larger percentage chance of them having the likelihood of there being groupthink than if you had to have a diversified pool of people bringing their thoughts together. So I consider that on an everyday lifestyle basis to be the banking board. And I also think that this is an important element because we, as banks, we service a diversified portfolio of clients. So you're not servicing the one type of client. You are servicing males, you're servicing females, you're servicing different ethnic backgrounds, you're servicing different ages. And you need to have an understanding, a good understanding of what your customer base is and what their priorities and what they would like. 70-year-olds who don't have the same, obviously no insult to them, but you don't have the same frame of mind with regards to technology, with regards to all elements that affect the younger generation, then you're not going to be giving that importance to your bank values. You're not going to give it to your business plan. So I would definitely consider that to be extremely important. And there's a lot of work that needs to be done locally. I think there's a huge need for these nomination committees that exist at bank level and shareholders themselves to think outside the standard box. So you have your usual pool of directors, and that pool has to grow through, I think, an active discussion that needs to take place. And all of this must never take place at the cost of competence. So competence, I think, comes first. And secondly, amongst that pool of the various competences that you have, you need to make sure that you have a diverse portfolio of people. And I think that is absolutely crucial.
Yeah, no, I agree. The competence has got to be the thing. I remember we were in one of our lunchtime sessions with non-committee chairs. I remember talking about, we got onto the subject of how do you get someone onto the board who's an expert in cyber, and someone talked about their experience in this, of that virtually anybody who they could get who's an expert in cyber completely failed to be an appropriate member to be a member of the board, because they were, completely different background. They just could not, they wouldn't be able to, pick up the overall need to be part of a unitary board. So they'd be great in terms of that cyber experience, but they're not well rounded. So yeah, you've got to think about these things. Now I'd like to move on to another current topic, which I've got a question on, and which we'd already planned to discuss, which is sustainability and climate change. Someone has asked about the MFA's focus on this, but I thought that before I come to David and ask about the MFSA's approach on the issue, just say a few words about where the MFSA is on this.
I can do, Nick. I mean, I can illustrate a number of things that we've talked about using this as an example as well. I mean, in a sense, we looked through the SI, the significant institution questionnaire, and we condensed that down into a few questions which we've passed on to our LSI population. So a proportionate way to get climate change, I think, onto the agenda and get some information in for the MFSA. And obviously we have a diverse set of banks here which will face or have to face up to the risks posed by a warming climate. Malta itself is dependent on its coastal economy for a lot of its tourism, and therefore quite a lot of the businesses here in Malta will have to think about how climate change will impact them, and that will have an impact on the customers of banks. We're a host jurisdiction for a number of trade finance banks, where a lot of the business flows that they finance will come through ports located on coasts that will be subject to changes as a result of rising sea levels. And there will be regulation that comes, whether it's on deforestation or on sort of mitigating or pushing down the use of carbon in our industries, which won't affect banks directly, but could affect a lot of their customer base. And there's likely to be pressure from regulators on increased disclosure about the risk posed by climate change, or indeed the way in which banks are financing climate issues if they're not sustainable activities. So and that will attract regulatory attention, and who knows, in the future may also include intervention. So again, I think this is one of the areas where boards, the regulators, and management are going to have to sort of retrain themselves, understand the risks, and start to think ahead, so that the business models that we're stress testing and ensuring are viable for the next kind of few years or so can also demonstrate a medium-term viability in a world that looks very different from now. So we have launched this questionnaire on the banking side to make sure we're aligned to what the ECB is doing. But the MFSA more generally has set up internal working groups to look at this on a cross-sectoral basis, and you can expect it to feature much more heavily in the regulatory agenda through the course of this year and into next. At this stage, I think it will be largely around assimilating what boards have thought themselves about this issue, and proactively identified whether or not they've got a way to proactively mitigate the risk posed by some of these the risks, and they've understood the risks that are posed to their business models. And we'll have to kind of develop the regulatory agenda, I think, depending on the results that we find. I mean, I think we'll be able to sort of look at those banks that have a proactive approach and can be are moving forward. Those that might need some help in that, and if there are any that are sort of trying to bury their heads in the sand, then we'll need to take sort of regulatory action probably more quickly to make sure that there's a right focus on this issue.
Thanks, David. Yeah, I think that makes sense. I mean, it's an interesting one. So, I sit on the Climate Risk Task Force at the International Actuarial Association, and we did a survey 18 months ago of the actuarial associations globally, and I think there are only 6 or 8 actuarial associations who are active in this area. But since then, we've seen a dramatic pickup. And essentially, we're seeing the actuarial associations working very closely with their supervisors and, you know, developing things together. So you can see how much this is picking up as the larger countries are developing processes and tools and so on, and that being rolled out to the smaller countries. Interestingly, we've got a lot of smaller countries with their own actuarial associations, and they just haven't got the resource to be doing the stuff that the bigger ones are. So we're actually undergoing an exercise to try and reach out to them, to try and help them do things in a proportionate way, you know, as the tools develop. And you know, clearly the banking side is working in the same way. So that's, you know, it's all good to hear, I think. I've got one more question for the panel, which I thought is really for David. So I think to finish on, which was just the overarching question of, you know, from your perspective and your experience, what does a good performance by a NED in a meeting with a regulator look like?
Polished. No, I mean, I think I said earlier, I mean, what am I looking for when I'm talking to someone? I'm looking for a sense of self-reflection and reflection. So an acknowledgement that across the complexity of a bank, there are always going to be issues. We're never going to be in a space where everything is fine, management's working perfectly, the resources are absolutely demonstrably adequate, that that there are no stresses that could have an impact on this bank. There are always going to be issues. So a non-executive director that is able to sort of talk to us a little bit about how they see that set of problems and how the board is managing them. What I also like to see is the non-executive directors giving us a good indication of their purpose on the board. The board is we judge a board's effectiveness on its sort of collective delivery, but each of the individuals within that is part of the team, and everybody obviously does better if they know what their role within that team is, and if they're able to talk to the regulator about that, and if that's mirrored in the way in which the chairman tells us or explains to us how they're configuring their board in order to deliver appropriate oversight, then that's helpful as well. I think the other thing is that non-executive directors can point to the bits of information that they are using. There is a welter, as you mentioned earlier, of reporting that can come up to the board, and sometimes it is difficult, as you explained, to disaggregate the wood from the trees. But there are some key things that a non-executive director can sort of focus in on in order to inform their view and judgment of an issue. And rather than just sort of talking to us sort of in a very high level sense, being able to relate it back to some of the information that they've seen and say, well, actually in that report, this is what was said, this is how we discussed it, that's how I kind of came to my view, this is how I benchmarked that view in terms of my own professional experience, but also in terms of sort of thinking about how it might impact other organisations and seeing whether or not we were doing well or not so well. I think it's those kind of things that I would expect to see followed through in answer to an interview question. And of course, the way we ask the questions, as the team explained earlier, will be as open as we can make them. They're the non-executive director's opportunity to get out onto the table all the information that they think is relevant for the regulator to have in order to make an assessment of the quality of governance and oversight in the bank. So it's an opportunity to sort of show us the thought process, the intellectual capability of the board in discharging its oversight responsibilities, to give us comfort that they understand the risks and that they have a plan and are realistic about what that plan is. So that's the spirit in which the interviews are intended. They're also obviously intended as a way in which the non-executive directors can ask us questions, and it's not a job interview, but a good non-executive director will probably use those interviews themselves to try and get to a conversational level with us that allows them to bend without obliging us, or we can't reveal other firms' information, but to get a sense of perspective on the quality of their performance and how we're judging it. So I think those would be my what I would aim for, and I think what the team here will be aiming for over the next couple of years as we roll out our new supervisory model.
Excellent. Thanks, David. Well, I think that brings to an end this particular section of the webinar. So I just take this opportunity of thanking all of the panelists for their contributions. It was all very, very interesting. So, David, I'll hand back to you for the concluding remarks.
Thanks, Nick. Well, I mean, I don't have anything else to say as well, other than to thank you for helping guide us through what I hope has been an informative session. And just to repeat what I said at the beginning, which is that this is part of the MFSA's engagement with the industry, in this case, the banking industry. I hope it's provided some helpful pointers, and obviously any feedback on what people would like to see us do next year or in between now and next year is much appreciated. But other than that, it just remains for me to wish everybody a good week, and thank you very much for your attention during the course of this afternoon.